Interest rate hedging products. What are they?
Well, as their name suggests, they're really quite complicated things. Fortunately, however, they're quite simple to explain. Allow me to do just that. An interest rate hedging product, or what is commonly called a swap, is a financial product or an agreement sold alongside a business loan. Many of these products were sold over the last 10 years by the big high street banks. Swaps were sold to protect against rising interest rates. In some cases, they were sold to fix the rate of interest for a period of time. In others, to limit the maximum amount of interest that would be paid on the loan if interest rates went up. There were various types, including swaps, caps, collars, and structured collars. Although each bank had its own terms for its own products, and each had a unique way of fixing or limiting the interest rate. As you can see, things can get very confusing very quickly. When sold properly, they could provide useful insurance against interest rate rises. The problem is, they weren't always sold properly. And for many businesses, especially small to medium-sized ones, they were a very big problem indeed.
Interest rate hedging products. What's the problem?
The fact is, there are two big problems. The first relates to whether or not they were suitable for small businesses. Interest rate hedging products, or swaps as they're commonly called, were designed to fix the interest rate or limit the amount paid if rates went up. Trouble is, rates went down to historic lows instead. That meant you were tied into a fixed rate and couldn't benefit from the drop. The result? Your loan cost much more than it otherwise would have. Secondly, the regulator estimates that of around 40,000 products sold, over 90% of them could have been missold. Here's why. They were sold to businesses they just weren't always right for. The implications of having them weren't always explained properly, and they often came with large exit fees that weren't always properly declared. In some cases, over 40% of the value of the loan. So, can you claim compensation if you were missold one of these products? Well, that partly depends on the size of your business when you were sold the product. If you met at least two of the following criteria when the product was sold, you may be able to use the regulator's redress scheme. 1, you had a turnover of less than 6.5 million, or 2, you had a balance sheet total of less than 3.26 million, or 3, you had fewer than 50 employees. If you don't meet these criteria, you won't be able to use the scheme and your options could be more limited. But all is not lost, because either way, we're confident we'll be in a position to help you.
Interest rate hedging products. Why all square?
Given all the problems with interest rate hedging products, your bank is likely to be in contact with you soon. In fact, they may have contacted you already. Banks have set aside £2.4 billion to deal with this issue, with that amount still growing, so it's clear they are treating this matter seriously. But before you sit down with them and discuss next steps, talk to us first. Allsquare is part of the Mitchell Farrer Group, one of the UK's leading consumer finance companies. We've helped thousands of people claim back millions of pounds for missold financial products. We're also led by experienced ex-bankers and lawyers, which makes us very well placed to help businesses that have been missold interest rate hedging products, such as swaps, caps, collars, floors, and fixed rate business loans. If you think you could have been missold an interest rate hedging product, such as a swap, why not get in touch? We'll make every effort to make sure you get all the help you need and everything you deserve. With Allsquare on your side, you're not alone.